Why does one landlord pay $600 a year for insurance while another pays $3,500 for the exact same type of property? Is it the suburb, the building, or just the insurer playing games? Stick around and I'll reveal what really impacts the price and how to make sure your money is working for you, not against you. Coming up in this video, you'll discover 3 things every property investor in Australia needs to know about landlord insurance. What landlord insurance actually costs in Australia, the key factors that impact the price, and how to get the best value without cutting corners. Now, I want you to think about the last time you bought a new phone. Trying to find a phone? Here we go. Now, most of us go straight out and buy a screen protector. And why do we do that? It's because we know accidents happen. The phone slips out of your hand, lands face down, and suddenly that small $20 piece of glass saves you from a $600 repair bill. And these days, more. Phones are so expensive. Well, landlord insurance works the same way. On the surface, it can feel like an annoying extra cost when nothing's gone wrong. But when something happens, whether it's a tenant damaging your place or a storm ripping through the roof, that policy is what saves you from forking out thousands, even tens of thousands out of pocket. This is why understanding the cost and what actually drives the price is so important. You don't want to underpay and be exposed, but you also don't want to overspend on cover that you don't need. Let's get straight into what you came here for, and that's price. Working with investors, and for what I see, most landlord insurance policies in Australia range from about $1,500 to $3,500 per year, depending on the property type and location. If it's strata titled and you're covering just contents, it might start from $500 to about $1,500. That's a ballpark every investor wants to anchor by when they're asking how much does landlord insurance cost in Australia. So let's talk about why landlord insurance prices swing so much. Why is one person paying $1,500 a year and the next person is starting at $3,500? Well, the first thing is location. Your suburb and postcode make a massive difference. If you're in a flood zone, a bushfire zone, cyclone prone, or even just an area with a higher crime rate, well, insurers factor that in straight away. Now, 2 houses built the same year, same size, same everything. Stick one in a quiet Melbourne suburb, stick the other in Townsville, near an area that's flooded before. Bang, there you go. Premiums are completely different. The same 4 walls, different price tag, all just because of geography. Now next, it's the type of property. Is it a freestanding house? Is it a townhouse? Or is it an apartment? Houses usually cost more to rebuild, which means higher premiums. But older buildings, think timber frames, old wiring, asbestos. Insurers know that they're more likely to cost big money if something goes wrong. Now let's talk about the level of cover. This is where people cut corners and they regret it. Some just take out building cover and forget contents. But contents means things like carpets, blinds, kitchen appliances, built-in wardrobes, things you don't want to pay out of pocket. And then the type of policy matters as well. If you've got a listed events policy, that only covers you for the risks that are actually named in that insurance policy. And then you've got accidental damage. This is way broader and it covers you in almost all scenarios. And then you've got to factor things like the extras. What about rent default, tenant damage, loss of rent? Each one might add a couple of $100s a year. But when things go south, those extras can save you tens of thousands of dollars. Now, next up, excess choices. This one's simple. The higher excess you have, the lower your premium will be. And the lower your excess is, the higher your premium will be. Now let's illustrate an example here. I'm a visual, I'm sure there's others out there that are too. You have a premium at about $2,000 with a $500 excess. Well, if you bump that excess to a $1,000 excess, your premium drops to $1,700. Now this is just for illustration purposes, right? These are numbers that I'm using just for this example. Now, over one property, that's $300 saved in this example. But if you scale that across a portfolio of 3, 4, 5 properties, that's some serious cash flow there. And this is why investors usually lean towards higher excesses. They know they'll only claim when the damage is big enough to wipe out that excess by a mile. Now, the next thing is claims history. This works just like car insurance. If you've claimed before even once, insurance see you as a higher risk. So 2 landlords with 2 identical houses can get totally different quotes just because one had a tenant trash the place and claim for it a couple of years back. Then there's the insurance companies themselves and policy differences. Well, there's no magic formula. Every insurer calculates risk differently. Some look cheap on the surface, but once you actually dig into the wording, they've cut out half the useful cover. So you're probably thinking, all right, Morel, I get it. Premiums, they go up, they go down, but what can I actually do about it? Well, this is where the smart investors really win. Well, first thing is match your cover to the actual risk. Don't just buy the shiny all-inclusive package if you don't need half of what's in it. At the same time, don't go the other way and strip it all back so you're left with practically nothing. Second, adjust your excess so that your premium and your peace of mind are in sync. Here's what I see time and time again. Owner occupiers want that lower excess because it's safer. But investors play it differently. They lean towards higher excesses because they're focused on cash flow. They'd rather pay a smaller premium every year and accept that if they ever make a claim, it'll only be for something that's big. And that makes sense because if you're only going to claim when the damage is significant, well, you want the premium savings stacking up year after year after year. Now, third, shop around. And honestly, this is where most people drop the ball. They get one quote, maybe two, and they just go with that. But insurers, they all price differently and they change things year to year. So make sure that you look around to compare the inclusions of the policies across different insurers and see which of these levers you can adjust to find the right balance. And if this feels like a lot of work, well, I'm an insurance broker and I specialize in investment property insurance. Feel free to reach out directly. My details are below in the description. Now, if you're planning to grow your investment property portfolio, getting this right early means compounding savings and consistent protection. Over a whole portfolio, these small decisions today add up big tomorrow. You now understand what landlord insurance really costs in Australia, the big levers that push the price up or down, and the ways to make sure you're not leaving money on the table. And when you're growing your portfolio, these decisions don't just protect you now, they shape the long-term performance of your investments.